Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Warner Brothers reopens negotiations with Paramount Skydance after it proposed or hinted at raising its bid and sweetening other terms of its offer. Plus, renewed selling in several tech giants are weighing on stocks with lingering anxiety over the outlook for AI. And Thrive Capital raises more than $10 billion in its largest fund ever, giving the firm an expanded war chest to invest in AI. Welcome to Bloomberg Tech, and this is what markets look like right now. We've carried over the holiday weekend in the US to the same anxiety, and we're going to talk later in the program about the contradiction right now at the heart of the AI trade. Nasdaq 100 off by a percentage point, chips kind of dragging us down, Mag 7. Bitcoin at 67,000 US dollars per token. Of course, it continues to trade 24/7, but over the weekend, a kind of 3-day period, there was a lot of geopolitical tension driving it. Our top story is Warner Brothers Discovery reopening talks with Paramount Skydance. Netflix has issued them a waiver. They can do so. It's a 7-day waiver through to February 23rd, by which point they either need to give a sweetened improved bid or something else needs to happen. Let's get the details. Bloomberg's Lucas Shaw leads our screen time team and coverage of media and entertainment. This is actually a little bit more difficult to understand than simply negotiations reopening. Talk us through the deadlines, the timeline, and what's new, Lucas.
Well, the news is obviously that Warner Brothers has decided to talk to Paramount. They have not been speaking for a couple of months. Paramount kicked off this wholesale process last year when it kind of sent over an uninvited offer, basically, for all of Warner Brothers Discovery. It then spent a couple of months increasing its offer every few weeks, trying to win. It lost to Netflix. And Warner Brothers Discovery has spent the last couple of months sort of trashing Paramount, both sides kind of waging war in public, if you will. But Paramount has gradually increased more and more pressure, addressed more of the board's concerns, and is now at a point where I think Warner Brothers Discovery feels both out of pressure from its shareholders and just because they're sort of tired of this, that they want to engage with Paramount for a week, see what happens. And if they can reach a better deal, then obviously, the board is going to do its fiduciary duty.
And we had some reporting about this over the weekend before the formal announcement this morning. Part of this is one of Paramount's bankers signaling to the board that there will be an improved offer, but that they haven't yet made their best offer. What do we know about that?
Well, Paramount has been saying for a couple of months that its offer is not last and final. Warner Brothers Discovery shareholders have been waiting for Paramount to increase the offer from the $30 a share. To your point, a representative of Paramount Skydance had indicated to someone on the board of directors of Warner Brothers Discovery that they would go up to $31 a share. My suspicion is that $31 a share still won't cut it. So the question is Paramount going to go to 32, 33, 34, 35? And at what point is that beyond what Netflix is willing to match? Because keep in mind that Netflix still has a deal with Warner Bros. Discovery and has the right to match any superior Paramount offer.
Netflix has come out with, I think we were talking about this offline, a strong statement, a lengthy statement. Just summarize what Netflix's position is here and where they fit into the idea that negotiations now are open for a window of time between Warner Brothers Discovery and Paramount Skydance.
Well, some of those sort of public hostilities or disagreements that I referred to earlier, I think are what Netflix is really seeking to attack with its statement. They are getting very tired of Paramount saying that Paramount has a clearer path to regulatory approval and offers a superior deal. And so Netflix goes through all the reasons why regulators might be concerned about a Paramount deal, including some of their international financing and the concentration owning 2 different movie studios. And that is also a jumping off point for Netflix to argue that the Paramount deal would be worse for Hollywood because Paramount would be a heavily indebted company that would have to cut billions of dollars in costs, whereas Netflix is buying a studio that it doesn't have in-house, and so it would preserve most of those jobs.
We're just showing the BI, Bloomberg Intelligence, react, by the way, which is pretty punchy. Netflix should walk away as Warner M&A drama heats up. Maybe we'll get to Geetha later in the week. Bloomberg's Lucas Shaw, you've led the way on the reporting on this one. Thank you so much. Let's get back to markets. Jitters around the software sector are sending investors in search of safety. Some of the industry's biggest names have lost hundreds of billions of dollars in market value so far this year. Add to that spending anxiety. Bank of America's latest fund manager survey shows a record share of investors think companies are overspending. This as the four largest US tech firms project roughly $650 billion in combined spending this year. Let's get the latest with Ted Mortensen, Baird managing partner. This is the heart of the AI trade right now, the contradiction in AI. Either AI is going to change the old economy and the new economy, or we are in an AI bubble. And for lots of people, both can't be true at the same time, kind of reflected in the trading of recent days. Where do you sit on that, Ted?
I think if you look at the agentic acceleration, this is something you can't ignore in relationship to traditional SaaS. I mean, the problem with the reason why the IGV is down over 22% year to date is people have a real worry on how to model these traditional SaaS companies from a free cash flow perspective, a multiple of free cash flow. And that's the big problem. I think over the weekend, 2 days ago, when OpenAI bought OpenClaw, that just gave more credence to this agentic explosion. If you look at some of the token growth that you're seeing, and this is why the cloud titans can't keep up with compute demand, is some of the token growth that you're seeing are triple digits month over month. This is not sequential. This is not year over year. This is month over month growth.
Ted, can I just jump in there real quick? So I didn't expect you to go to OpenAI, OpenClaw. That blew up right over the weekend on social media. Right. And what I'm trying to do is understand the story of how public market investors are treating this versus what we see in private markets. That clearly is a consolidation of different platforms, right? Just try and unpick that for me.
I think it's really a debate between the old and the new, and I think when you can't model the old, going back to that SaaS assumption on free cash flow multiples, and you're looking at this acceleration on agentic, people just are getting out of the way, to be quite honest with you, and they're going to 6 other sectors that are more infrastructure related. And the feeling is that some of the traditional SaaS companies will have problems going from a traditional SaaS model to a consumption model, which is all agent-based. And it's a mess. It's an absolute mess if you're a software investor trying to model these companies.
Ted, with respect, I don't think you really answered my question, which is, you know, the contradiction of the old and new economy, software more recently being impacted, and then are we not in an AI bubble? You mentioned cash flows. One of the interesting pieces of math that people are doing is the capital expenditures commitment of the hyperscalers and its impact on cash flow, or proportion of cash flow. Basically, cash flow is getting wiped out. How do you feel about that?
I think it's a problem X of Google and Meta, which have their supporting businesses on the advertising that can actually make up that free cash flow. Where I get pushback is names like Amazon and even Microsoft to some degree, to a more limited degree. But if you look at Amazon, I mean, they essentially had to lay off a very large component of their white collar employment base to maintain even getting to neutral free cash flow. So it is an issue. One of the things that we are not talking about is memory. And when you have this token, I would say, acceleration, and you have inference also expanding, we have a huge memory problem. And I would almost put it at a crisis level where you're not going to have enough memory to support this compute over the next 2 years. That's a real issue out there.
Next week, Nvidia reports its earnings, and it's the biggest beneficiary of the capital expenditures numbers we talked about. Right. To this point, it has shown massive real top-line growth. What would it need to show or evidence to carry the rest of the market with it next Wednesday evening?
I think number one, they have to assure investors that they don't have a memory problem, which they don't. I mean, Jensen was so far ahead of this memory issue by locking up supply. That's number one. Number two is some of the Blackwell numbers, as well as transitioning the timing of Rubin, is also very, very important. This is a real change on infrastructure on Rubin, and I think anything that they can assure investors that's on track, and the adoption of Rubin from a system perspective is not cannibalizing any of their business as it relates to, for example, Google's TPUs or inference silicon.
Right.
They've got to play in both realms.
Ted Mortensen of Baird, I think you've set us up for a number of weeks to come. Thank you very much indeed. Now, coming up, Ford charges ahead with a more affordable next-gen EV. Shares a little softer but came back after headlines hit. We're going to go under the hood next. This is Bloomberg Tech. Ford may have taken a $19.5 billion hit to overhaul its EV business last year, but the US car maker is out to prove that it hasn't retreated altogether from electric vehicles. Ford revealed details of how it's engineering a next-gen EV platform to go further on a single charge and still start at $30,000 US. To do this, the company's head of EVs, Doug Field, told Bloomberg it had to start with a clean sheet for its organization and design process. Let's get more with Bloomberg's Keith Norton, who has covered this company inside and out since 1985. And it's important to be specific here, right? This was an engineering exercise, the universal EV. What did they actually do to engineer out cost and stay in the game?
Well, as you said, Ed, they did it far from Detroit. This was set up in California. It was led by Alan Clark, who's a former Tesla engineer, and they sweat the details. It's like improvement by 1,000 cuts. And they've managed to shrink the size of the battery on this EV. The battery is the most expensive component of an electric vehicle, while at the same time extending the range by about 50 miles. That's just one of many engineering gains they made, which is the reason they can field this vehicle at $30,000 as a starting price, which is $20,000 below the average price of a new car in America today.
We spent about 45 minutes on the phone with Doug Field, which was a really interesting exercise. There is a pathway here, right? It starts 2027 with a pickup truck. And they go basically from skunk works to reintegrating back into the might of Ford with maybe distant, Keith, ambitions on L3 systems. What's the sort of timeline from here of this UEV platform, please?
Yeah, not exactly that far distant. They're going to come with the eyes off the road level 3 semi-autonomy in 2028. So a year after they launch this vehicle, they'll offer buyers the option of getting this semi-autonomous eyes off the road, hands off the wheel feature. So their point is they can put a feature like that on an inexpensive car in the 30,000s, which is unusual. Normally, those sorts of advanced technology features show up first on very high-end luxury cars closer to six figures.
Right. The approach from Ford thus far has been to electrify the big winners, thinking Mach-E, thinking F-150 Lightning. That's gone now, right? And the focus is... That's gone, right? And the focus is China. So put that context out there for us, why this approach, ground up, starting from fresh, is the right way to counter the cost basis of a Chinese EV company.
Right. So the advantage the Chinese have is in price. I mean, there's a Chinese EV in China for $10,000. Not likely that would come here, but they have a big price advantage, even if you make a car ready for the U.S. market. But they also have a technology advantage. They have, cars that are essentially an extension of your smartphone, smart cars. So you need to compete against them both on price and technology. That's what Ford says it's doing with this because of the approach they've taken. It's not just an affordable vehicle, they say, but it's a desirable vehicle with lots of good features.
Bloomberg's Keith Norton, who again has led the charge on covering this industry and this company for a long time. Appreciate it. Let's talk about Apple. It's touting an in-person experience event in New York, Shanghai, and London for a March 4th product launch, suggesting a lower-key showcase than often held at its Cupertino campus. Let's get out to Bloomberg's consumer tech and Apple managing editor Mark Gurman. There's the event and how they'll do it, right? Different to the kind of keynote-style format in Cupertino. But it's harder, the products. And I think you were on very recently kind of telling us what we should expect from this.
Yeah, there's a lot in the pipeline for the first half of this year. I don't think that everything is going to show up at this event. There's just too much stuff for you to have in one showcase. But if you think about why would you need an event? Why would you need an in-person experience in 3 different places, right? Hotspots, London, Shanghai, New York, right? These are as big of metropolitan areas in the world as you can get. It means they're launching something pretty significant. So my eyes are on this new low-cost MacBook. It'll be in the $700 to $900 range. It will be their first MacBook powered by an iPhone chip. It'll be slightly smaller than the MacBook Air, but the price point is a really big deal. This has the potential to really overshadow Chromebooks and some of the PCs we're seeing out of the Windows market right now. So this is a really big deal. The other new things that are in the pipeline for the first half of this year, new MacBook Pros, new MacBook Airs, the iPhone 17e, as well as new iPad entry-level and iPad Air models. I would think that we would at least get the 17e by this event at the latest.
I want to clear something up for our audience because you put me on the spot the other day. I'm running a MacBook Pro with M4. That's my work one. At home, I've got a 2020 Mac Air running M1, and you quite rightly pointed out I should upgrade. When they hold these events, how quickly do the new products hit the shelves? Quickly?
When it's a spec bump, they're rolling out within a few days. The longest delay is usually about a week, 2 weeks maybe maximum, but it's usually pretty quick.
Bloomberg's Mark Gurman, who's been on top of the reporting on this well in advance. Thank you very much. Now, coming up, we're going to discuss just how big a market the physical AI space can be. That's with Zanitza Todorova from Barclays. That's next. This is Bloomberg Tech. A report from Barclays projects that by 2035, physical AI could be a $1 trillion market, thanks to advances in brains, brawn, and batteries. So where are the investment opportunities along that value chain? Zanitza Todorova, Barclays head of thematic FICC research, and the author of that report, joins us now. In many ways, Zanitza, it's an update. You know, you're keeping the research alive. So we have the $1 trillion addressable market, 2035. But digging down into the notes, actually, autonomous driving is a really big part of this for you.
That's right. Our latest research shows that physical AI could really become a $1 trillion market by 2035. That's 10 times higher than where the market is currently valued at. And that $1 trillion estimate spans 4 key robotics categories: autonomous vehicles, humanoid robots, advanced automation, and drones. And look, while I have really strong conviction that the late 2020s and early 2030s will be the decade of the robot, I also think that growth and adoption will likely come in stages rather than all at once. I can see how autonomous vehicles could lead the trend and set the stage. And in fact, nearly half of that estimate of the market growth comes from autonomous vehicles, or in dollar terms, that's about $500 billion by 2035. I think also intuitively, this makes a lot of sense because autonomous vehicles clearly have a head start. The technology has been around for nearly a decade now. The production process is there. It can leverage an existing automotive supply chain. And I think more importantly, the AI models needed for autonomous vehicles can work with a much bigger real-world driving data set that's collected from millions of vehicles out there. And that's a very different story if you compare to where humanoid robots are at the moment.
So if you follow the arc of what happened with autonomous driving, what needs to happen for humanoid robots for them to make a meaningful contribution to your $1 trillion forecast for addressable market by 2035?
I think the number one challenge that humanoids face right now is the lack of physical AI data. And that's because when you think about humanoid robots, they really bridge the gap between the cognitive, the digital, and the physical world. And in the physical world, the laws of mechanics and physics apply. A humanoid robot needs precise instructions if it's going to function and perform properly in an unstructured world that is made for humans. Take a simple example such as lifting a box. This is a very simple task for us humans. We have inbuilt dexterity, we have inbuilt intelligence, we know exactly what we have to do. But a humanoid robot needs precise instructions. It needs to know exactly how much force to apply, where to apply that force. And that simple example can get really tricky if something changes. If, for example, the box is actually heavier than expected, if the surface is slippery, that means that the robot needs a new set of instructions. And the challenge is that there is no dictionary out there. There's no single database that can tell us, look, for a 50-pound box, you need this amount of energy, this amount of force. All that needs to be built from scratch in order for the technology to scale and to become more useful in the real world.
In both cases, autonomous driving and humanoid robotics, and actually you could extend that to autonomous drone technology as well, there is a great emphasis on China, how far ahead it is in commercializing the technology, but also supply chain dependency. A lot of that supply chain has historically originated from China. How does that show up in your research?
So it's clear that China leads. I think it deploys robots on a completely different scale. For example, in 2025, we estimate that nearly 15,000 humanoid robots were deployed worldwide. 85% of those were installed in China. You get a similar story if you look at other types of robotics technologies like industrial automation. There, we're talking about 50 to 60% of the units are installed in China. If you compare these figures to what's happening in the US, the numbers look very different. Low teens for humanoid robots and even single digits for industrial robots. So the scale is very different. So China has the advantage in terms of technology, also access to raw materials. Take, for example, critical minerals, rare earths. You need a lot of those components to build some of these very, very specific physical components that go into a robot. So there are different chunks of the supply chain where China can really kick in. So all that comes together. But having said that, it's still early stages. I think we are just scratching the surface in terms of what physical AI can do. And I see lots of potential for that adoption to accelerate in other parts of the world, starting with the US and even potentially in Europe in a couple of years' time.
Zanitza Todorova of Barclays, it's great to have you back on Bloomberg Tech with your updated research. Thank you. Some news crossing the Bloomberg terminal. Palantir says it has moved its headquarters to Miami, Florida, from Denver. They made the announcement via a pretty straightforward and simple post on X, the social platform. The shares kind of haven't really moved from where they were trading anyway, but an interesting story will continue to track. Now, coming up on the show, Bitcoin having a tough time after the long weekend. We're going to discuss what's ahead for cryptocurrencies, a lot of focus on geopolitical risk right now. And of course, while it was a US holiday on Monday, Bitcoin trading 24/7 around the world. And you see since Friday, that's what it looked like. Markets actually not as anxious as they were when we woke up. It's halftime. This is Bloomberg Tech. Welcome back to Bloomberg Tech. If you're just joining us, volatility has gripped Wall Street, particularly when it comes to conversation around the AI trade. Right now, the Nasdaq 100 is actually just a little bit softer, 0.3%. The Philadelphia Semiconductor Index, or SOX, was down 2%. We're now off by 0.2%. Again, we're seeing volatility, and Nvidia, one of those names participating in it. There are some news stories I want to pick out while we get the opportunity. Gemini Space Station, the crypto exchange founded by the Winklevoss twins and IPO'd a few months ago, is down 14%. Basically, in the months that followed the IPO, a lot of the C-suite has left. They confirmed this morning the CFO, Chief Legal Officer, Chief Operating Officer all left. That's putting volatility in that name in the crypto adjacent space. And generally speaking, cryptocurrencies are struggling to find clear direction after a weekend rally fizzled, erasing a small bounce that briefly took Bitcoin close to $71,000 per token on Saturday. It has been a tough run for crypto, especially with Bitcoin posting 4 straight weeks of losses. There is one person who I rely on to help with this, and that is Bloomberg's cross-asset reporter, Isabel Lee. So most of America was on a holiday on Monday in the United States. Crypto is a 24/7 thing, and it's a global thing. But it was interesting to kind of track from Friday through to this morning, where you net out $67,000 per token, and the stories on the Bloomberg are about geopolitics.
Bitcoin never sleeps, but over the weekend and during holidays, we must recognize that liquidity is thin. But to your point, we've seen 4 straight weeks of losses, and there are just a lot of things going on. We have renewed geopolitical tensions when it comes to Iran. Fed rate cuts are back in focus, especially after last week's inflation report. We also have AI concerns. So my inbox, Ed, as I'm sure yours is just full of AI concerns about whether this sell-off we're seeing will spill over the tech sector. So all of that is causing Bitcoin, which is now really a risk asset, moving a lot in step with NASDAQ. It's really edging lower. So that's what you're seeing. It's interesting because we still have the original Bitcoin proponents saying that this is a haven. This is what you buy when there's geopolitical tension, inflation fears. But for now, it's definitely behaving like a risk asset.
Bloomberg's Isabel Lee with the crypto summary. Thank you very much. Latest 13F filings from Soros Fund Management has revealed that it's doubled its stake in Microsoft, jumping from about 102,000 shares to 263,000 shares here. With the latest is Bloomberg hedge fund reporter Hema Palmer. What do we need to know here about Soros?
Right. So when we look at his move here, doubling his stake in Microsoft, this is a stock that, as we now have seen with the beginning of the year, has become incredibly volatile, down 23% since the end of the third quarter. So, you know, these 13 Fs today are actually quite insightful because we're seeing positioning ahead of what's been a chaotic start to the year. So as we can see, who made the right bets, who is probably in pain, the stock's not doing too well. Soros also added to Apple, Nvidia, and Amazon. And there's been pain kind of across the board.
It has. It's interesting, the 13F exercise. Either you start with the hedge fund or the fund, or if you're me, you kind of look at the change in positions of the names. University of Texas came up. Why?
Yeah, so on the flip side, they actually trimmed their Microsoft stake and their Amazon position. They ramped up their Apple holding, which has been less painful for them as we look at through the end of September when we look at these filings through till now. They do have a large portfolio, over 300 positions, so we saw some good rotation in that. But the interesting move there was ramping up Apple and also trimming Microsoft.
Bloomberg's Hema Palmer across all the 13Fs. Thank you so much. All right, a lot more to come on the show. Startup Mesh is out to build the, quote, largest optical manufacturing footprint outside of Asia. Lasers, optics, everything AI. That conversation's next with a funding raise. This is Bloomberg Tech. Elon Musk's SpaceX and xAI recently merged, are competing in a secret Pentagon contest to develop voice-controlled, autonomous drone swarming technology. According to sources, it's a $100 million prize that only a handful of companies were selected to take part in. Here with the story, Bloomberg's Katrina Manson. This was a fascinating read. It's a kind of new domain for SpaceX xAI. It's a contest. What do we need to know here?
This is really the frontier of the future of war. This is everything that folks like Stop Killer Robots and others have been warning about. This is the Pentagon trying to experiment with completely new tech that has so far been failing. It's experimental. And this is a moment really where the AI companies are coming to the fore quite unexpectedly. Elon Musk is the very same person who said that he would have nothing to do with new tools for killing back in 2015 when he signed on to an open letter from AI researchers and roboticists saying, we do not want autonomous weapons. And now this is the Pentagon trying to create autonomous weapons. These are weapons that can select and engage targets of their own accord. The contest is not explicitly saying they will be doing that, but they are saying that drones will be moving around and taking commands from voice and turning those into digital instructions.
I don't know that the prize money is necessarily the main headline for SpaceX, right? What you do really well in your reporting is explain where the technology is at and where various institutions want it to get to. So we have drones, but it's this swarming idea in the, I guess, defense use case. What needs to be cracked?
I think there are 4 stages. First is, as you say, there are drones. Everyone's become familiar with drones because of the Russian invasion of Ukraine. And Elon Musk himself said in 2024 that if there is a major power war, it's going to be a drone war. So everyone is very focused on what that might look like in the case of a US-China contest over Taiwan. People have flown multiple drones together. That's not the same as a swarm. A swarm really is where the drones talk to each other, they interact with each other, and ultimately, potentially, carry a payload or a weapon and can drop that weapon on a target. Weaving in AI to do that for targeting, automatic targeting recognition, and in this case, to take a command from someone giving a voice instruction and turn that into a movement or an action is relatively uncharted territory.
I should say that SpaceX and XAI did not respond to our request for comment, which is pretty normal procedure for them. What they are doing is hiring some interesting roles bi-coastally, but you know, in the classic talent pools of Silicon Valley. What areas?
This is DC and the West Coast, and of course SpaceX, a long-term defense contractor, but never in offensive weapons, nothing ever so explicit. And XAI, I mean, this is Grok, this is X, what we're all going to post this story on afterwards. They are now hiring for people with clearances, and that's a real change. They're looking for people with secret clearance and top secret clearance.
Bloomberg's Katrina Manson, top reporting. Thank you very much. There are so many other news headlines in the world of tech. Time now for Talking Tech. And first up, Anthropic's talks to extend a contract with the Pentagon are being held up over additional protections the company wants to put on its Claude tool. Anthropic wants to put guardrails in place to stop Claude from being used for mass surveillance of Americans or to develop weapons that can be deployed without a human involved. According to sources, the Pentagon wants to be able to use Claude as long as its deployment doesn't break the law. Plus, Thrive Capital has raised more than $10 billion for its largest fund yet. The venture firm, founded by Josh Kushner, draw far more demand than it could accept, turning away billions of dollars from prospective investors. The interest underscores the success of several of its portfolio companies, including OpenAI, SpaceX, and Stripe. And sticking with Thrive Capital, the firm just backed a startup building optical transceivers that are crucial for data centers. The startup is called Mesh Optical Technologies and was founded by SpaceX alumni. And it's raised $50 million, led by Thrive, to scale manufacturing of the technology in the United States. The company's co-founder and CEO, Travis Brashears, joins us now. This is such an interesting field. It's one that Nvidia has looked at. The use of optics in GPU is also, or OPU, is being looked at. Let's start with what you're offering, the actual technology itself, which we wrote about this morning.
Yeah, thanks for having me on the show. And yeah, we just announced our company, Mesh Optical, coming out of stealth here. We are standing up high volume optical manufacturing of these optical interconnects that are used for all GPU clusters. So anytime you hear someone talking about a GPU cluster, there's 4 to 5 of these optical transceivers for every one GPU. And so, yeah, we're excited to offer our first product as what we call a linear pluggable optic. And it's at like a 1.6 terabit per second data rate, which is like what the state of the art will be in the coming years in all these GPU clusters.
Trevor, you were at SpaceX for about 5 years. You're the laser guy, right? Working on the technology stack that helps satellites communicate, essentially. Your co-founders, also SpaceX alumni in slightly different domains. But how is that transferable to what you're doing here in the first instance with the transceivers?
Yeah, great question. And no, I was super excited to have a lot of the team that I worked with there deploying the Starlink laser mesh, and we're very proud of what we did there. And, you know, I think about the job here every day, and it feels very similar to what I was doing at SpaceX. And, you know, SpaceX, the space laser team was quite small and a very awesome team. And we're building the same thing here, a very small, like technical oriented team with really talented individuals. And the day-to-day feels very similar. We're, you know, standing up high volume production, trying to deploy as much hardware as possible and co-locating the talent right next to the manufacturing line. And so, yeah, it feels very similar.
This is about more than the underlying technology, right? This is a field where the supply chain is dominated by China. And so one of your ambitions is to exceed that, bring capacity to the United States. And you've put a timeline of 2027 on that. This is a big debut funding round, but what's the roadmap from here? You're going to need more capital. What are your priorities?
Yeah, our priority is to build as many optical interconnects as possible and deploy as many of those as we can. So for the immediate term, it's getting to high volume of this first device we're making, while at the same time planning for our long-term ambitions of doing space-based laser communication and eventually one day propelling spacecraft with photons.
Right. So explain that distinction, right? In the first instance, who's the customer? Data center on Earth. And then in the future, there is a distinction on this happening in space.
Yeah. So first customer, we got to help the U.S. deploy this compute on the ground as fast as possible. And, there's a big vulnerability in the supply chain with regards to optics and the way those optics are assembled and manufactured all overseas. And standing up a secure supply chain outside of, Asia and China specifically really helps us leverage our product into all of these data centers on the ground. And when we show how much volume we can do on the ground, it's, then we have to start pushing that volume to space, and we'll be the ones strategically set up to do that.
Just real quick on Thrive Capital, a big day for them. They're leading you around. Why is it important that they are backing you?
Yeah, they, from the beginning, have just been ready to go with us and deploy quickly. And, our goal is to stand up this volume production as fast as possible. And they were also willing to work as fast as possible with us. And we really appreciate them backing the founder and also wanting to accelerate.
From the time that you were at SpaceX, clearly the bigger vision has changed. Right now, space-based data center, that's what we're going towards. Do you expect to work with your old company and with Elon Musk to try and pitch the technology back into them?
I'd always love to keep working with them and help. I just want to help connect as much compute and send probes to deep space as much as possible, and whoever we can work with on that, I'm very excited to do that. And connecting everything from the ground to space, it's going to need to transition to optical because RF reaches a limit, and optical photons are much more efficient and power efficient. And the constraints on the ground are power, and the constraints in space are also power. And so it leads very well for what we're making here.
We're hearing that a lot on the show of late. Photons are the future. Travis Bashir is co-founder and CEO of Mesh. Thank you very much. Now, coming up, digital talent manager Knight raises a new funding round as it looks to expand its business. We have more on that next. This is Bloomberg Tech. Talent management firm Knight has raised $70 million to expand its business across music, sports, gaming, and live events. Knight's founder and CEO, Reed Ducksher, joins us now. This is digital Hollywood, right? And the management of top talent. It's interesting to grow through venture. What do you need the funds for?
Yeah, we're going to use it for a few different things. I mean, we're primarily focused on talent management here at Knight, but we do have a venture studio. We've went on to fund things like Feastables and Tone with Kai Cenat. And so for us, I think the thesis was always that talent of the future are born on the internet. That is very much still our thought going into the future. And so we're going to use that to be what we think is the internet's media company.
Which platforms right now are launching careers? I know that is a broad question, but if we talk to the giants in broadcasting and streaming, or we talk to YouTube, right, they would all kind of accept that it is a battle for eyeballs, even if they're slightly different mediums. So which platform are you seeing launch the people that you hope to serve?
I think there's two that stand out to me, especially in my industry. YouTube obviously being the first. We just saw that they announced they have almost 13% of connected TV watch time. So they're beating Netflix, they're beating Amazon, they're beating HBO. The next one is TikTok, I think just primarily because of the discoverability of content through short form. It doesn't matter if you have 10 followers or 1 million followers, a good video can get a lot of views and go viral. And so I think that has created a lot of careers just because of that top of funnel that's created, regardless if you have followers or not.
You've been at this a while, right? It's not as if Knight just suddenly came about overnight. It's 10 years of work. I think Now at this stage, the timing of the raise, what was the strategy behind that, Reed?
Yeah, we've grown very linear over the last 10 years, through signing different talent, through the venture studio. It felt like a perfect time for us. We feel like we've never been more right than we are right now in our thesis of internet native talent being the future of celebrities. And so for us, like the last 10 years were all about like, how do we educate? How do we continue to represent the biggest talent on the internet? We think the next 10 years, like attention is the currency. We think that individuals or consumers are more loyal to individuals now more than ever. And so as we continue this thesis, this is a company that hopefully I can run for the rest of my life. We'll see. But I think the next 10 to 20 years, we still believe in this internet first talent born on the internet. The future state of celebrity is born on the internet. And so it felt like the perfect time for us to make a larger move.
You've done some M&A, for want of a better expression. 2004, Knight acquires the Roost Podcast Network. Last year, Experiential Supply Co. Is this kind of the plan now? Like the $70 million can go towards some interesting properties like that?
Yeah, we've done those organically off the balance sheet. Like we've always been a profitable company. We've had a successful career, and so we bought the Roost from Warner Brothers when they were looking to sell that asset. Really like building our media sales apparatus. Acquiring Experiential Supply was another thesis that we're going to continue to run after. Like we do think the world lives on the internet, and we do think the future state of celebrities are born on the internet, but we also think that consumers value in-person experiences more than ever in the future. We are still bullish on live events and experiences for individuals, and so that was a lot of that acquisition. The money will go towards buying things that make sense for the culture that we've built here over the last 10 years, businesses that we think intersect with the internet. And so a lot of what we're going to look at going forward is things in those categories.
Reed, from Knight's perspective, how do you think about what's happening with Warner Brothers Discovery, the Netflix part, the Paramount Skydance part? Does it have some ripple effect in your world where the talent's heads get turned about the health of industry wide, or it's just not a concern?
No, it does. I think the issue is just the consolidation of all these companies provides less buyers in the ecosystem. And so you're seeing a contraction of shows getting sold. And we've now seen that over the past 3 to 5 years. I think that's just going to continue. I think the consolidation, worries a lot of people. Like we are based in Los Angeles, although we aren't necessarily traditional Hollywood. We do have shows and have sold shows to those streaming services. I think the interesting place where we sit as a company is that 90% of our client roster sees YouTube or being a large YouTube or TikTok creator as the end game for them. Like they want to be large internet personalities. They want to control their intellectual property. They want to control their editing and have final cut and final say in the product. And so I think it affects us way less than it maybe affects the traditional talent management companies whose revenue concentration is primarily through entertainment services that's provided from a TV network or a Netflix, where ours, like the primary revenue source is YouTube AdSense, brand sponsorships. It's very different. And so although it does affect us, it's on a much smaller scale.
Reed Ducksher, founder, CEO of Knight. It's great to have you on Bloomberg Tech. Thank you very much. That does it for this edition of Bloomberg Tech. What we were just discussing, right? This morning's news that Netflix has issued a waiver to Warner Brothers Discovery, allowing them to negotiate with Paramount Skydance. It's 7 days through February 23rd, and Paramount either has to improve their bid or something happens with Netflix, which is a bit softer. They came out with a strong statement saying that they feel very confident in their existing bid. And you can definitely go back, listen to the conversation with Luke and Shaw. In markets more broadly, we are seeing volatility. We had some serious declines at the index level. The NASDAQ 100, the Mag 7 names, the Philadelphia Semiconductor Index, they were all markedly lower. Now, actually, the SOX is higher, but there has been volatility coming with that. We'll continue to track it. As I said, please recap. We have the podcast. You know exactly where to find it on the Bloomberg terminal, as well as online, Apple, Spotify, and iHeart. This is Bloomberg Tech.